Today I would like to analyze Costco, one of the largest and most dominant retailers in America. If we're going to take a look at the stock price, we can see in the 5-year charts we are up to 203%. So we're going to take a look at the financials to find out if this company is still a good buy right now. The first thing we can recognize is a huge market capitalization of 427.5 billion US dollar. This makes Costco the second largest supermarket chain by the market capitalization. We also have a dividend yield of around 0.48%. This is not very high, and we can see it has an inconsistent growth in the last years. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business, not a declining business. So we can see here in 2020, the revenue was around 166 billion US dollar. This was a 9% increase on 2019. So this is a good growth. Then 2021, around 17% growth, also very good. Then 2022, around 16% growth. Then 2023 around 7%, and then 2024 around 5%. So overall, I would say we had a good growth, especially 2021 and 2022. So it's a check here, but we can also see the growth is slowing down in the last years. The next thing we're looking for is free cash flow growth in the last 5 years. So this is a very important number because it can be used to pay the dividend, to pay stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 6 billion US dollar. This was an 80% increase from 2019. Then in 2021, we had around 11% decline. This is something we don't like to see. 2022, again, around 34% decline in the free cash flow. Then we had a strong growth in 2023, around 92%. And then again, 2024, around 2% decline in the free cash flow. So overall, what can we say? We had a slow growth, and it's still a check here because it's a growth in the last 5 years, but we had some decline as well in some years. This is something we don't like to see. If we take a look at the operating cash flow, we can see we only had one time a decline in 2022, around 17%. So instead of the free cash flow decline in many years, in 2021, 2022, and as well in 2024, it was only one time a decline in 2022. And the reason for that is in the operating cash flow, we take minus the capital expenditures. And we can see here the capital expenditure did increase over the years, especially in 2024, around 400 million increasing in the capital expenditures. So this can be one of the reasons why the free cash flow was declining, but the operating cash flow is growing. The next thing we're looking for is a free cash flow yield over 4%. So this is important because it can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So what we're going to do now, we're going to take the free cash flow for 2024. So this is around 6.63 billion US dollar. Then we're going to divide it with the current market capitalization of 427.5 billion. So then we're going to get the free cash flow yield for 2024. So let's calculate it together. The number we get is around 1.55%. So I think this is very low, and it's an indication for overvaluation here. So it's not a check here. I think this free cash flow yield is very low, especially because it's already a huge company and it can be more difficult to grow the free cash flow in the future. So I think we would like to see the free cash flow way higher right now. So I think we should also make some assumptions about the free cash flow in the future. If we assume here in ChatGPT, it says 2025, maybe around 5.8 billion US dollar, 2026, around 6.3 billion US dollar, 2027, maybe around 6.9 billion US dollar. So if we assume for 2027, let's say 7 billion US dollar, we can calculate this quickly as well. Divided with the current market capitalization of 427.5. Then we're going to get a different number. So this number would be the future assumption for the free cash flow yield. So the number we get would be around 1.63%. So this is still a low number. So even if we assume that the free cash flow can grow in the future and in 2027 can be around 7 billion US dollar. I think still this company looks very overvalued. The free cash flow yield is just very low, and this means they not have a lot of capital to invest in the business from the free cash flow. They not have a lot of free cash flow to pay the dividend, to pay the stock buybacks. So I think this is something we don't really like to see. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can pay back the debt with the free cash flow in under 5 years. A very important number, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt. We can see here it's around 5.8 billion. Then we're going to add the short-term debt as well. So the short-term debt, we can see here around 0.1 billion. So then we're going to divide it with the current free cash flow. The current free cash flow is around 6.63 billion. Then we're going to get the ratios that we are looking for. So the number we get is around 0.88. So this means in under 1 year, we can repay the debt with the free cash flow. This is a great number, so it's a check here. The next thing we can looking for is the cash on hand. So how much money this company has in the bank. We can see here around 11 billion. This is also a great number. It means they have enough money to invest in the business or to pay their dividend and to pay stock buybacks. So we like to see that it's a very good balance sheet. Now we want to see the enterprise valuation to free cash flow ratio under 25. So this again can tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So this now includes the debt and includes the cash on hand as well. So this is better than the market capitalization, because the market capitalization is just a stock price multiplied with the share outstanding. So what we're going to do now, we're going to take the market capitalization 427.5 billion. We're going to add the debt. So how much was the debt? 5.9 billion. Then we can take minus the cash. So this was 11.14. And then we're going to divide it with the free cash flow. So the free cash flow we're using is 6.63 billion. So then we're going to get this ratio. So this can tell us about the valuation. So first we're going to get the enterprise valuation. So this again is the market cap plus the debt 5.9 minus the cash 11.14. So for the enterprise valuation, we get the number 422.26 billion. So this is how much the whole company would cost, including the debt minus the cash. So this number we're going to divide with the free cash flow. The free cash flow was around 6.63 billion. So then we're going to get the number 63.68. So this number can tell us about the valuation. It's a very high number. We would like to see it under 25. So for me, this is a big indication that this company is overvalued. So of course, if this company can keep growing the free cash flow, maybe at some point the valuation will be okay. But I think this company is already very huge, and this will be more difficult to grow the free cash flow in the future. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. So we like to see that, especially if we think the company is undervalued. So we're going to take a look, and we can see here, actually this company doesn't really buy back their own shares. We can see here the shares outstanding did increase slightly over the years, not really much, but it's not a buyback. So it's not a check here, they're not buying back their own shares. This is not necessarily a problem, but we like to see that if we think the company is undervalued. I would like to give my conclusion about this company. So let's start with the positives. So we had some good revenue growth in the last 5 years. We also had some free cash flow growth as well. We have a good balance sheet, which means low amount of debt and a good amount of cash on hand. Then also I think we have a good business model here. We have the subscription, we have the retailing, very strong and cheap products. So I think this is a good business, but the valuation is very high. we have a free cash flow yield around 1.55%. This is very low, so it means they not have a lot of free cash flow to invest in the business or to pay out with the dividend or to pay out with their stock buybacks. The enterprise valuation to free cash flow ratio around 63.88 is again an indication that this company is overvalued. So we also have a very good performance in the last 5 years, around 203%. So I think this company is doing well, but I think the current valuation is very high. If you found this video helpful, don't forget to like and comment and subscribe for more content.